morning to all. In today's session, we are going to learn what is all about the monetary policy, credit control, instruments, what is exactly the money multiplier, and it's all about the quantity theory of money. So let's begin. What is the meaning of monetary policy? So basically, monetary policy is one of the type of the government policy which always been announced twice a year by the government of India, or you can say the Central Authority of India, that is the Reserve Bank of India. The main purpose of the monetary policy is to ensure that there should be a price stability for the economy. There are various factors which ultimately influence or include the monetary policy, that is the money supply, the interest rates, and the inflation. In terms of banking and an economic view, money supply is always referred to M3, which include the legal currency of money, that includes coins, you can say the currency notes in the economy, and the public has to accept under that particular currency and utilized for their own purposes. When it comes to Reserve Bank of India, it always announced the rules and regulations, the new norms for all the banking and the insurance or financial sectors, as well as the financial institutions which are basically controlled by them. So that is the view of the monetary policy. In other words, the monetary policy is also called the credit policy, which always shows in a particular, in a very organized statements, which always been announced twice a year along with the Reserve Bank of India, so that a particular price stability should be maintained in an economy, and accordingly the national income could continue to generate by with the help of Reserve Bank of India. Let's talk about how the monetary policy is different from the fiscal policy. When we talk about the fiscal policy is always being used to overcome or to reduce the recession and control the inflation. The monetary policy is always regulate the money supply as well as whatever the availability of the credit, you can say, in the economy. Monetary policies always deals with the borrowing and the lending rates of interest for the commercial banks under the supervision of Reserve Bank of India. Monetary policy aims to maintain the price stability, the full employment in the economy, and of course, the economic growth of a particular country. Monetary policy is always be different from the fiscal policy, as the monetary policy is always brings the changes in the economy through the money supply or the supply of money or any changes in the interest rate. But fiscal policy is a broader conceptual framework tool with the government. It always focuses about the government spending, the taxation, and the debt. So that is the main difference between the monetary and the fiscal policy. When we talk about the fiscal policy is always being used to overcome or to remove the recession and control the inflation situation. That means if any change in the government revenue and expenditure, it automatically influences the national output and the prices in the economy. And that is the main difference, that when we talk about the monetary policy, it always ensures that there should be a price stability and full employment situation and of course the economic growth. But when we talk about the fiscal policy, Fiscal policies always focuses about the revenues, about the expenditure of the country, which having a direct or indirect influence on the level of national output and the prices. And the monetary policy is always focused regarding the supply of money, which always depends upon the demand of money and ultimately its cost. So whatever the available credits, you can say available in the economy, that to be taken according to the norms of the RBI, that is the Reserve Bank of India. So this is a difference between the monetary policy and the fiscal policy, or in other words, I could say that how the monetary policy is different from the fiscal policy. Now we talk about what are the objectives of the monetary policy. So when we talk about the objectives, it's always been ensured to maintain the price stability and always have an adequate flow of credit to all those productive or the factors of production in the economy. It could be land, labor, capital, and the entrepreneur or enterprise. So when we talk about the stability for the national currency is also the one of the objective of the monetary policy, to look up the prevailing or the pre-economic conditions. When we talk about there should be a growth in the employment and income, that which is also the one of the objective of monetary policy. As I already told that monetary policy is always focused to maintain or consistently, you can say the economic growth. So that is the one of the objective of monetary policy, that there should be a growth in employment and income, which always looked upon by the government. Another objective is that it affects the real sector when we talk about the long or short period, in terms of the financial transactions made by the financial institutions, whereas the financial markets is also influenced for any short-term implications accordingly in the market. So when there is an implications, whether short-term or long-term, it automatically influenced by the financial markets, and the monetary policies always ensure to maintain these short-term or long-term implications, so that the financial market would become stable in the would become stable in any of the situation, whether it would be the you can say inflation, whether it would be the any other productive situation, when these particular markets would take or its transactions would take place. Now we talk about the instruments of monetary policy. So these are the eight instruments, which are where the credit you can say could be controlled in case of inflation. So when we talk about the bank rate of interest, cash reserve ratio, statutory liquidity ratio, open market operations, margin requirements, deficit financing, issue of new currency, and credit control. So let's go on through one by one of these instruments of monetary policy. Let's talk about the bank rate of interest. So if we talk about this particular rate of interest, which has been decided by the Reserve Bank of India, so it is a rate of interest control the lending position or the credit capacity of the commercial banks. The commercial banks are the banks which are mainly responsible for lending the money to the public, which on the particular interest rate which has been fixed by the Reserve Bank of India. In case of inflation, if the RBI increases the bank rate of interest, so it means the borrowing power of such banks could reduce. And ultimately, if the borrowing power of the banks could reduce, then ultimately it also reduces the supply of money or any credit in the particular economy. So when the money supply reduces, then automatically you can say purchasing power reduces, and if the purchasing power reduces, that means the consumption automatically keep you can say curtail or keep reducing, and ultimately the particular the Reserve Bank of India and the commercial banks would automatically would reduce the prices of its product and ultimately to control the problem of inflation. So one of the main reasons to control the problem of inflation is just to stabilize the prices, to lower the prices, and it could be reduced when the supply of money or the credit in the economy could reduce. So if it reduce the purchasing power or the borrowing power, and the consumption would automatically reduce, and when such a power, whether it would be the purchasing and the borrowing would reduce, then the prices would be reduced. So this is a way that how during the inflation or in terms of inflation situation, how the RBI works while it increases the rate of interest, ultimately the borrowing power or the lending power or the supply of money would automatically reduce, and when all these factors would or the segments would get reduced, then the prices of the particular product would also reduce. So this, and ultimately it controls the situation of inflation in the market or for the commercial banks which are under the supervision of Reserve Bank of India. So this is one of the control, credit control instrument, that is the bank rate of interest which has been fixed by the RBI. The second one is cash reserve ratio. So when we talk about the cash reserve ratio, it's very important to first understand the exact meaning of the cash reserve ratio. Cash reserve ratio, it refers is some portion of deposit or cash which the banks have to keep and maintain with the RBI. The portion of cash which the banks need to reserve or maintain with the RBI, that portion is exactly called the cash reserve ratio. So in case of inflation, if the RBI increases the cash reserve ratio, it means the commercial banks have to keep the higher or the greater portion of their deposits with the RBI or to the RBI. Reason behind of this particular increases the CR because a portion, whatever the portion of the bank deposit is, it's totally risk free, and there is no risk involved while reserving the particular greater portion of the cash to the RBI, and ultimately the RBI controls the liquidity in that particular monetary system, and hence it controls the inflation situation immediately. So this is also the one of the you can say instrument of the credit control, and it can be controlled when more and more portion of the deposit or the cash have to be kept with the RBI by any of the commercial banks, so that with the main two purposes, that first it is totally risk free, and the second, the RBI have a pure capacity to control the liquidity in the particular banking system, and ultimately it controls the situation of inflation. So that is the one of the you can say instrument of the credit control is cash reserve ratio. Next one is statutory liquidity ratio. When we talk about the statutory liquidity ratio, So automatically the banks, whatever the deposits they have, they require to invest that particular portion of their deposits into the government securities. The government securities, it would be the shares, it would be the bonds, it would be the any other, you can say, promissory notes where the you can say debentures where the particular banks are required to fix their to invest their deposits in such government security, which is called the statutory liquidity ratio. Whatever the portion of the deposit is being invested into a government security, that portion is exactly called the statutory liquidity ratio. It would be 1 by half, it would be the 1/5, it would be the 1/7. So that exact ratio is exactly called the statutory liquidity ratio, which the banks would like to invest some of the portion. It would be 75%, it would be the 30%, it would be the 50% portion of the deposit, which will be invested in the government security, and that's called statutory liquidity ratio. Now, in case to control the inflation, if the statutory liquidity ratio increases, then automatically the lending capacity, the credit capacity of the commercial banks will automatically decreases. Why the lending capacity? Because whatever the deposits of the particular banks will automatically invest in the government security. So whatever the portion they invest, so automatically you can see the lending or the credit facility of the commercial bank will become decreased. And automatically when it decreases, so it is very necessary to regulate the supply of money in the economy. So automatically we talk about the statutory liquidity ratio. If it increases, the credit capacity of such banks will automatically decrease, and there is a situation to regulate the supply of money in the economy, and that could be done through the statutory liquidity ratio, because whatever the portion they deposit in government security, and in case of the emergencies, in case of the financial crisis, that government security will help to the banks to pay off any crisis, you can say it's occurred in the particular future. So that's called the statutory liquidity ratio. Next one is open market operations. So when we talk about the open market operation, it ultimately refers the buying and selling of whatever the government securities. It would be shares, it would be bonds, it would be debentures, it would be the commercial papers or any other securities in the open market. So in case of inflation, if the RBI sells off all the securities in the open market, then ultimately whatever the money they used for selling the securities, ultimately that money will transfer to the RBI, that is Reserve Bank of India, and in this way the supply of money will be controlled in the economy. So that is called the open market operations, where the sale and purchase of government securities would occur and would be possible in the open market. So in case of inflation, if the Reserve Bank of India sells all those securities in the open market, then ultimately that particular amount of the sale will transfer to the Reserve Bank of India, and in this way the situation of money supply will easily be controlled in the economy. Next one is margin requirements. When we talk about margin requirements, so automatically the Reserve Bank of India will fix up. It would be the higher rate of margin or it would be the lower rate of margin to control the situation of inflation. So in case of inflation, the Reserve Bank of India fix up a higher rate of margin on those securities which kept by the public for loans. I, I repeat once again about the margin requirements. In case of inflation, if the RBI fixes up the high rate of margin, all those securities where the public kept for the loans to the banks, then ultimately you can say the commercial banks will give up the less amount of credit on the securities. I repeat once again, in case of inflation, if the RBI fixes up the high rate of margin, that means the commercial bank have a capacity to provide any credit to the public and with a less amount to control the inflation situation. So if any of the bank fix up any high rate of margin on all those securities which were capped by the public for loans, then ultimately commercial banks will provide the loan facility at a very less amount to the public, and automatically in this way the situation or the concern of inflation would get controlled. So that is called the margin requirement, which is the one of the you can say credit control instrument of monetary policy. The next one is deficit financing. It means where the Reserve Bank of India would been into a process of printing a new currency notes in India. So if more and more new notes are printed, automatically it always increase the supply of money. You can say, and ultimately, if the supply of money would get increased just due to the increase in demand and prices. So this way, you can say if the RBI print more and more notes, so automatically there all the factors would get increased, whether it would be the supply of money, whether it would be the demand of money and its associated prices. During when we talk about the inflation, the RBI will stop or will avoid any printing of new currencies. Why? Because to control the inflation situation. It is due to the fact that if the bank would print the maximum notes, the supply, demand, and prices of money would get increased automatically. But in inflation, RBI have an authority that not to print any new notes because the situation of inflation where the prices is on a high or a peak rate. So in that case, if the bank would print a new notes, then automatically the supply of money and demand of money would get increased. That means the situation of inflation would not get controlled if supply of money and demand for money would get increased. So if the bank would stop any new printing of the currency notes, then automatically inflation situation would get controlled as the supply of money and demand of money would not get increased, and automatically the situation of inflation would get controlled and the prices would remain you can say fixed or remains constant in that particular situation. So that is called the deficit financing. Now we talk about the next is issue of new currency. So when we talk about the issue of new currency, so during the inflation, the Reserve Bank of India is always issue a new currency notes. Why? Because the bank has to replace the old currency notes into a new currency note. So reduced in the economy, and ultimately the situation of inflation would also get controlled. So once the bank would issue the new currency, like more and more currency they will issue just by replacing the old ones, that means old notes, and automatically the supply of money will get decreased in the economy. And in this way, the credit facility will also get increased by the commercial banks to the public in case of inflation. Now we talk about the next term is fiscal policy. Fiscal policy is another type of government policy which refers to government spending, taxation, and the public debt. In other words, I could say the fiscal policy refers to a revenue and the expenditure policy of the government, which is generally control the recession and of course maintain the economic stability in the economy, to maintain the national income of the economy, and that is all about the fiscal policy. These are the instruments of fiscal policy. The first one is reduction of government expenditure. As in the particular definition of fiscal policy, it is maintained that to sustain the economic growth, the economic stability of the economy, and the economic would stable when the government expenditure would get reduced and the revenue government revenues would get increased. So that's why in this way the fiscal policy would get work, as the government has to stable the economic stability or to maintain the economic stability of the economy. Next one is increase in taxation. So one of the, when there is an increment or an increase in tax rate, so automatically the public would pay up the taxes to the government, and it increases the revenues in the particular sectors. It would be the, and it could be used to invest or to spend the money by the government for the development purposes, like for making up the dams, for making up the road construction, and in many more services, or to repair the, you can see, old hospitals, or to construct a new hospitals into a different reasons. Why? Because if there is an increase in taxes also, the government have a you can see capacity to invest or to spend the money which called revenues for the government, and accordingly they invest for the public welfare. So that is the one of the instrument which is called the increase in taxation of fiscal policy. Next one is imposition of new taxes. We can talk in the last years, we can talk about the gross sales tax, that is GST. And if we talk about the GST, is every item, it would be the electronic items, it would be the food items, or would be the any alcoholic items, or would be any beverages. So if the new taxes has been imposed, that means it automatically increase the revenues of the government, so that the economy of the country would get you can say would get maintained in an overall basis. So that is the main reason that imposition of new taxes is also the one of the instrument of fiscal policy. The next one is wage control. When we talk about the wages, when we talk about the packages, even the wage packages for the workers, for the employees, it automatically on an controlled way, because if the packages would be segregated differently and not according to the new skills, then automatically the fiscal policy will not sustain in the economy. So automatically the wages control would also be the one of the instrument of fiscal policy. Next one is rationing. What is rationing here? Rationing is just to control the prices of the market. Why? Because it is a situation where the inflation, in case of inflation, the prices would get increased frequently in the market. But rationing is a solution to control that prices, to make the prices stable in the economy. That's why it is also the one of the instrument of fiscal policy. Next one is public debt. So automatically, fiscal policy would also helps to pay off the debts of the public by through the you can see the banking institutions, through the insurance institutions, or all others financial institutions. The next one is increase in savings. As more and more taxes would impose, the revenue would get increasingly saved in the particular government accounts when it comes to the one of the instrument of fiscal policy. The next one is maintaining the surplus budgets. When we talk about any surplus budget of the government, if occurred in a new financial year, so easily through the fiscal policy can be easily maintained through showing up the surplus any of the account that could tend to be maintained through the fiscal policy. When we talk about the other measures of the fiscal policy, so these are the other measures of the fiscal policy to increase in imports of raw materials. So whatever the raw materials that we used for any type of constructions, so through the rate of imports could increase, then it could be done through the use of fiscal policy. If there is a decrease in exports, that could be done through the fiscal policy, because the fiscal policy has a capability to decrease the export, and automatically it could be controlled a situation of recession. Next one is increase in productivity. So the productivity could also get increased if more and more skilled and knowledgeable workers would come and join the particular industries. The next one is provision of subsidies. So automatically the subsidized or the subsidy could controlled or could be protected through the fiscal policy, and it's belong to the you can see the spending, taxation, and the public debt. The next one is use of latest technology. So when we talk about the use of latest technology, of course, the government revenues is also getting increased through imposing the new taxes to the public, and ultimately once the savings could increase, the government had the capability or capacity to use up latest technologies in the economy or in the own country. So it would be done through the use of fiscal policy in main instruments. The next one is the industry policy should be reasonable. rational. So whatever the rules and regulations and norms is to be introduced uh, for the new industrial policy or for exact industrial policy should be rational. It should be uniform in all the industries and the policies and the norms could be followed by all, every industries by the, you can say, their workers or their senior management heads. So in this way, these other measures was also helpful to control the situation of recession and immediately the economic stability in the economy could be maintained through the use or by the use of fiscal policy. The next one is money multiplier. So when we talk about the money multiplier, in other words, it is also called the monetary multiplier. That means it set up a maximum limit by which the money supply could be affected if there is any changes in the money deposits. So when we talk about in monetary economics, the money multiplier is the process of creating the money in the economy in the form of the created creation, and it could be done through the use of banking systems. It could be, in other words, I could use the fractional reserves banking system. The banks who hold a greater portion of the money to the RBI, and through which the money could be created in the form of created creation. That process is exactly called the money multiplier. And in other words, I already explained, it also refers to the maximum limit by which the money supply could be affected if there is any changes in the money deposits with the banks. So mathematically, every multiplier, it would be the money multiplier, it would be the any cost multiplier having a mathematical formula to calculate. But in case of money multiplier, the formula stands for 1 by R. R, as I already explained, which is one of the instrument of the you can say my monetary policy, that is the cash reserve ratio, or in other words, I could say the required reserve ratio, where the banks could hold up, you can say a reserve a greater portion of money and to the RBI. So that exactly called the cash reserve ratio. So if this is a formula of the money multiplier where the R is given and accordingly you can calculate the money multiplier. It means if the R is higher, then money multiplier will be the lower. That means there is an inverse relationship between the RR and the money multiplier. It means the banks need to keep more and more reserve to create the credit, and automatically if the credit would get created, then automatically the money would get created and the supply of money, the supply of money would get increased. But there is an inverse relationship between the cash reserve ratio and the money multiplier. That means bank has to keep more and more reserve to lend the money to the public. That means it means the bank would not be able to lend more and more money to the individuals and businesses if there is an inverse relationship between the reserve and the money multiplier. That means that the credit creation would not be possible. Bank will not be able to lend more and more money to the individuals and the businesses. So this is an overview of the money multiplier in the form of short note. The next theory is the quantity theory of money, which is one of the most important theory in your examination. This theory basically is formulated by the Polish mathematician which called name is Nicholas Copernicus in the year 1517. But it was later renewed and popularized by the economist, which is the name called Milton Friedman and the Anna Squidwich. Such theory has become popular in the name of a monetary history of the United States in the period 1967 to 1960 year, but it was popular exactly in the year 1963. This theory is mainly focused on the changes of the prices and the money supply. That means this theory is also stated when there is a multiple variations, or you can say multiple changes in the prices are related to the exact variation or the changes in the other factors. So such theory is also known by two famous names, that is called the new quantity theory and the Fisherman theory. This is the two names which are very popular to you can say called up or associate with this theory. This theory is also suggests that when there is a change in the money supply, it due to the changes in the price level. That means there is a fixed fractional and the proportional relationship between the money supply and the price level. So this theory, it's mainly related to the variation or the changes in the money supply and price level. And in other words, I could say if there is a changes in the money supply, it's just due to the changes in the price level. That means there is a fractional and a proportional relationship between these two terms. In a general sense, I could also say that quantity theory of money is that particular theory which deals with the increase in the quantity of money, and ultimately it also creates a situation of inflation and vice versa. So if there is a decrease in the quantity of money, it could create a situation of recession. So if there is an increase in the quantity of money, it would also create or tend to create the inflation situation. So if there is more and more money is to be printed out by the Reserve Bank of India, then the inflation situation would get increased. Same concept would be applied in the quantity theory of money. If the more and more quantity of money would be there, that means is automatically it increase the inflation situation. And this theory is always state this only due to increase the inflation and how to control the national income when it comes to the full and below employment rates. According to the quantity theory of money, if any of the amount of money in the economy would get increased by twice, then the price level is always double. As I already told, it is a fractional and the proportional relationship between the money supply and the price level. So if automatically if the money in the economy would get increased twicely, then the price level will also get increased. So it means the customer will have to pay the twice as much for the same amount of the goods and services. That means if the consumer or the customer would like to buy any good and services, they have to pay for that good twice for this of the same amount. So that is called the quantity theory of money. And automatically, when this drastically increase in the money, then automatically it also increase in the price level. That ultimate the result would be the increase in the inflation level. So automatically, what the inflation is the increase, frequent increase in the prices of goods and services. So once everything would increasing, money is also increasing, price level is also increasing. Ultimately, inflation would also get increased. So this theory states that only if everything is increasing, customers paying twice for the same goods and services, then ultimately the inflation situation will get definitely get increased. And this theory states this only if everything will get increased, inflation situation will definitely occur in any economy. It is the same forces also when the demand and supply of any commodity, of course, it also influences the supply and demand for money. So automatically, when there is a change in demand and supply of any commodity, then definitely it also influence the supply and demand of for money as well. So if there is any change or any increase in the supply of money, then automatically decrease the marginal value, decrease the additional values for of the money. So when we talk about in any simple manner, the money supply would get increased. That means the purchasing capacity of the customer of any another one unit of the currency will also get decreased. That means if supply of money will increase, that means the purchasing power for having one additional unit will automatically decrease. So to adjust such decrease in the money marginal value, the prices of the goods and services would get increased. And if the prices would increase and the money value, marginal value of money would get increased, then automatically it result into a higher inflation level. So this is the exact scenario of quantity theory of money. It always says that there is a proportional relationship or a positive relationship between the supply of money and the price level. If money creation of money would is increases, prices also increases, it also increases the inflation. But when there is the supply of money increases and it automatically decreases any additional one unit of money. That means the money supply would get increased, but the purchasing power of having additional unit of money would definitely decrease. And to adjust such decrease, you need to increase the price level. If the price level increase, the higher inflation level would also get it also having a situation in the economy. This is the equation of the quantity theory of money, which I already named that it is called the Fisherian theory or the neo-equal theory. So the equation under this particular quantity theory, there is a Fisher equation which called M into V is equal to P into T. M is the money supply, V is the velocity of money, P is the average price level, and T is the volume of transactions in the economy. And how much the transaction would be used in the economy. So if both you can say M into V, that means money supply and velocity, that means the quantity of money would would be on the left side and the price level and the volume of transactions in the economy would be the right side. If both are equal, that exactly called the quantity theory of money according to the Fisher. Fisher is an economist who has developed this theory, which in other words is called the Fisherian theory. This is a diagram which has been described of a quantity theory of money and the price level. In this particular diagram, there is a two employment stages. It's a below employment and full employment. So if we look at the below employment in the form of shape, it's a trending shape which stands M1, M2, and Y YF. So when we talk about YF, it is a rate at the below employment rate. It is a YF is a below employment rate. So when we talk about the below employment rate, the money supply or the supply of money is also decreases. As you can see, it's M2 to M1. So YF to M2 to M1, so it automatically the money supply decreases, and ultimately once the money supply decreases, then this theory is applied into a new version where the price level and the quantity of money would get studied. So in this case, the you can say demand for money, it's begin from the origin where the below employment rate ended. That is O. O stands for origin, and demand the curve of demand for money. It is a 45-degree angle line. This particular diagram states that at the full employment level, the quantity supply of money and the price level is proportional to each other. That means both factors are, you can say, is having a positive relationship between them. If there is any change of quantity of money from M3 to M4 due to and automatically resulted or tends to an increase in the price level from P3 to P4. So we have to show up in this diagram positive relationship which begin from the below employment rate to the full employment rate, which is shown in the one particular diagram. And ultimately, when this quantity of supply, quantity of money would get increased, the price level would get increased, then automatically it would create a you can say a situation of the inflation. That means the monetary policy will help to control that inflation, and the fiscal policy would help to control the situation of recession. And ultimately, when we have a tools where the inflation situation would arrive, so the policies would come up to overcome from the inflation or recession, and ultimately it would create the economic stability in the economy, and of course will maintain the national income of the economy through the fiscal policy. So this is an overview of the diagram, interpretation of the diagram which has been portrayed in this particular session, and in front a particular graphical representation has been shown on the screen. So this is the diagram which has been shown over here, and this is a small explanation of this diagram. So this classical relationship between the money supply and price level has been shown in the figure, that is 4.1. So this diagram is actually shows a relationship between these two particular parameters at the full employment, which has been shown in by 1. So this is a diagram, and this is an explanation which I have explained in my own words. So that's it for today. These are the all important topics which I have covered as much as maximum the whole particular session of this particular course code. That's it for today. Thank you so much for listening, and namaste to all.